Here we go. Getting ready. 3, 2, 1. Hey, welcome to Be the Boss of Your Money. I'm Mitch Goldberg, your host. This is my live stream. It's your live stream about personal finance, investing, the stock market, taking control of your money. That's why I call it Be the Boss of Your Money. You've got to be the boss. You've got to look at your money like it works for you, as opposed to you working for your money. Does that make sense to you? Anyway, the big call today, the most bullish call that I could find anywhere, is all about bank stocks. Own bank stocks, bank. And bank stocks are definitely doing well this year. But I mean, come on, we're only 4 days into the new year. So let's take a look at that and see if the call means something. And how could you invest in bank stocks? Using exchange-traded funds. We'll do a little ETF review on 2, count them, 1, 2 financial ETFs. So let's roll the intro. And here we go. Hey, thank you so much for joining me. We are just getting started. We're going to talk about bank stocks, just bank stocks in general, big banks, regional banks, investment banking. You know, should you invest in JP Morgan? Should you invest in Bank of America, Goldman Sachs, maybe BlackRock, the giant fund manager? How do you do it? What's a good way to go about it? You can take a shot on individual stocks. I want to look at exchange traded funds. I think that could be a more suitable way for many of you, in a more diversified way, to just generally own the sector. When I say diversification, I mean as in it's a strategy we use to mitigate risk, but it doesn't necessarily protect your portfolio from dropping in a generally down market. If you're just joining us, I want you to ask questions. If you have any questions about the topics that we're talking about, if you have questions about personal finance, what have you, you know, I just love hearing from you, and it makes the day so much better. So the market did not really rebound. I was very unimpressed with the day in the markets. I didn't really expect anything either. If you watch the show every day this week and the week before the holidays, I was like, you know, it's time. It's you know, we're making a shift. The Fed's shifting. What's changed though is the Federal Reserve has gone from we're going to wait, we're not going to change policy, we're going to stay easy peasy, and all of a sudden they're like, we've got inflation, we're going to scale back our bond buying by March instead of over the next like 7 or 8 months, and we're going to raise interest rates right after that. You know what? We're going to let the balance sheet run off too, which is not just staying flat with liquidity, it's actually going to withdraw liquidity from the market. It's a big deal, and it's totally catching investors, not you and me, but some large investors. It's creating market moves. People are caught off guard, who expected the Fed to remain easy for a much longer period of time, and all of a sudden it's like the Fed is. It's you know, you've heard this before. The Fed has could be behind the curve. The Fed is basically, in my view, acting like it's behind the inflation curve. So it's moving quickly, and it just caught the market off guard. We were thinking we'd get a rate hike in maybe June or September, another one maybe November or December this year. Now we're looking at March. I mean, March? It's, we'll be in the beginning of March very soon. The Fed meeting, I don't know the exact date in March. It's about the middle of March, let's say. But we're getting very close to rate hikes, end of QE, and the Fed balance sheet. What this means is this: the Fed has a little over let's say $8.3 trillion on its balance sheet of bonds. And when bonds mature, the Fed replaces that bond with a new bond. Or when a bond matures, It just rolls off the balance sheet, and the Fed doesn't replace with a new bond. And when that happens, it withdraws the amount of that maturing bond. It draws liquidity in that amount out of the economy, out of the market. Okay, and that means it's shrinking, and they could shrink it pretty quickly. A lot of it is short-term stuff. It's a shame that the Fed didn't issue like a 50 or 100-year bond, like 6 or 7 months ago when rates were really low, and a year ago even. And can you imagine like setting out 100-year bond at like under 2%? That would have been like the most prudent move ever. Actually, the Fed wouldn't have issued the bonds. The Treasury would have issued the bonds, but that's just getting into semantics. Okay, government debt we're talking about there. Let's see who's out there. Josh is out there. Thank you for the emojis, my friend. Right back at you. And who else? Melanie, I see you are out there. Thank you so much. I know, Melanie, it's like I have to turn this into a podcast. It's just, I'm sure I could figure it out. It's like we're all busy. I know. You know what I mean. But I hope you're having a good winter, and I'm sure you're thinking about getting some golf in. It's daylight savings time's coming up pretty soon. And Jay is out there, my friend Jay. So good to see you, buddy. If you have any questions, folks, go right ahead and ask me in the comments. So let's move on. Let's take a look at a couple of things. Pop myself up at the corner. Let me get rid of the emojis, and I'm going to explain to you what that picture is, that goofy picture is of me. What do you think of this? I'm playing with a new marketing idea, and I'm getting a really good response. This is me standing outside of my building. I used a tripod to take the picture, and this is Route 110 behind me. My building is right on the corner of 110. We're like a primo location, and that's Route 110. Behind me is the Long Island Expressway, which is like the main artery, east and west, that goes into the Midtown Tunnel, which goes into Manhattan. I'm about 35 miles outside of Manhattan. So, and I made this knock, who, I haven't posted this one yet. Knock, who's there? Never going to click. Never going to click who? Never going to click on your Calendly link in the DMs. That's who, mofo. So I'm just playing around with these. Payment for order flow is bullshit. If you know about Robinhood and how that exchange, how that brokerage firm makes money, you get that, right? And this is what they look like, though, before I do anything. It's a blank piece of cardboard, and then I use Canva to write on it in a font that makes sense for the size of the cardboard, and that looks like I handwrote it. And then I dole out the ink, the writing, to make it look like the black ink from the marker was at least absorbed a little bit into the cardboard. And it basically, it's free. Like, it didn't cost me anything to do this. Okay, so let's go back. Here, this is I'm going to post this tomorrow. It's, if I know, cut off the bottom, but it says, if your holiday joy disappeared when you received your December credit card bill, you have a whole year to change that. Make a U-turn and read this again. It's just, I think it's, I think I'm so funny, but I posted two of them, one yesterday and one Monday, and I got hundreds of likes, Facebook, LinkedIn, Instagram, and it seems like it took off and people really appreciate it. It's like just like a very simple little education and a very quick little card. And I'm really, I'm having fun. What do you guys think? Let me know in the comments. Okay. Jay says, love it. Thank you very much, Jay. Really, I really appreciate that. Thank you. And Phil is out there. And Phil, I just want you to know, man, I still look at it because it's such an awesome picture. This is Phil, Philly, and Deborah, and Ivory. Look at that. You're famous now, Phil. Look at that. You guys are famous. Best Christmas card I got. Thank you very much. Really, really appreciate it. People don't really send out cards anymore. It's like, so when you get a card, it's like, ooh, wow, what nice a card. 20 years ago, you get like a stack, and now it's like you get one or two, right? We all rely on social media. I don't know if it's better or not, but I like getting the card. All right, so let's talk about the market. So the Dow continues its slide down 170. Not that big of a deal, but in light of its big drop yesterday, it adds up. But the Dow is still over 36,000. I don't think anyone has anything to complain about. A little indigestion, a little burp at the after the year, right? After a good year. Did I just do that on a live stream? Burp? Yeah, it's not a real burp. Nasdaq off a fraction of a percent. No big deal. To me, that's a winner after yesterday's pounding in tech stocks. S&P basically flat off 0.1%. Gold, I always tell you, gold, now it's again back under 1,800. Gold just does not move. And if people were really worried about inflation, I think gold would be higher. Now, I know there is inflation, by the way. Don't be like, oh, come on, Mitch. Oh, wow. Big news that just came out. I don't know if you could see that. I'll take myself out of the screen for a second. You see that GameStop share surge on report. It will create NFT marketplace. All right. So, oh, come on. All right. We're finally seeing the news, something out of GameStop that would give the stock a lift. And the 10-year yield up to 1.72%. It was at 175 earlier in the day. And let me pop myself back in here. Okay. So you see that the 10-year yield, 1.72. VIX still a little under 20. So there's not really an indication that investors are nervous and fearful about mayhem in the market. Mayhem in the market. It's like a cool thumbnail for the next live stream. In the market tanks again. And the Rust 2K up a little bit. That got pounded yesterday as well. And now let's talk about the sectors that did the best today. Energy, financials, industrials. I always say that. That's like the triumvirate that I always give you guys. When you look at the market, I always say industrials, financials, right? And energy. Those are the three sectors you want to see rally if there's that show economic strength. Why could these companies go up if the economy is getting stronger and the Fed is looking to tighten interest rate policy, shrink its balance sheet, do all the things that we don't like to hear? I'll tell you why. These companies are relatively cheaper than the high growth stocks, in particular the high growth tech stocks. And when the economy is doing well, their earnings don't just go up a little bit. Their earnings leap by bounds. Just these companies are high. They have operational leverage. So a little bit of extra revenue because the economy is doing better could be a big percentage in terms of earnings growth because they're so leveraged in terms of their operating leverage. I guess what I'm trying to say is their fixed costs don't rise, and these companies do everything to get their costs as low as possible. So extra money coming in sales and in sales, it goes right to the bottom line, expands. Companies go up, PE multiples go up, stocks go up, and that's basically that's the story with what's happening with those kinds of stocks. It's not. I don't really see that stopping. All right. Now let's talk about. Let me just make sure I had this up here. So you see energy, financials, industrials were the leaders. And at the bottom of the heat, materials, healthcare, utilities, and technology. Consumer staples and discretionary were real estate was but real estate had a really good year last year. All right. So let's talk about bank stocks and financials. That's the crux of the show today. Okay. Oh, well, it's nice to see you in this camera as well. And if you do have any questions, please go right ahead and ask the questions in the comments or, maybe words of wisdom, words of encouragement, keep going, Mitch, rah, rah, rah. Oh yeah, Mitch is the man. That's always really cool. Appreciate that. Okay. And I'll give you applause. Okay. I think the biggest bullish call by analysts is to buy bank stocks. And I'm going to show you just a news flash from on CNBC from Goldman Sachs and from Michael Mayo of Wells Fargo, very prominent bank analysts, especially Michael Mayo. He's always considered the top guy, the axe when it comes to bank stocks. So I'm going to show you what they're recommending, what they say about bank stocks, and we're going to look at a way to invest in them. Okay. So first, let's take a look at the Goldman Sachs news. Okay. All right. Goldman sees 3 reasons why banks are headed for a big year, and here are its favorite picks. Okay. Well, I guess, Bank of America is one of them, right? Bank stocks should perform well in 2022 with 3 major factors driving performance. Over the past year, bank stocks rallied substantially. Yes, they did do very well last year, reflecting the increasingly attractive outlook for the operating environment going into 2022. Goldman's Richard Ramsden said today. Off to a strong start. Goldman cited higher interest rates as a driver for banks. That's really what it is. Okay, but let's take a look at his stocks. Okay, he sees capital markets normalization, blah blah blah. Stock valuations should also play into sector performance as investors decide which names are attractive relative to earnings. We see the market is differentiating between banks with high and low return profiles here, and we expect the market to continue to seek out growth of more profitable platforms. So he picks JP Morgan and Bank of America as his top 2 picks. I know the article said 3 picks. Well, it said 3 reasons. The 3 reasons why the analyst sees bank stocks are up, but his 2 picks are JP Morgan and Bank of America. And I would say no Shinola Sherlock. Okay. I mean, if you're going to buy a bank stock, odds are the first one you would buy would be JP Morgan because they're the biggest one, and it just seems to always be that's considered the best. Okay, we on the street think that's the best name, and then you go a notch below and you say Bank of America, and those are really the 2 marquee names in the industry. Wells Fargo gets a lot of play, a lot of positive talk about it because they're right now looking like they are getting through the regulatory issues of the phony account scandal that they screwed over their customers. But people forget, and now they're doing well, and they've made a lot of corrections and in their governance. And now they're going to probably be able to start buying back stock and holding on to less reserves and things like that. And those are the kinds of things that increase earnings per share. JP Morgan is just a juggernaut, biggest bank. And I'm not sure if I think it's the biggest bank in the world. Definitely the biggest in the country. If it's not the biggest bank in the world, let's call it top 3. Okay. So, and then let's go to the next one. Okay. Let's go to this one. Okay. Wells Fargo's top banking analyst, Mayo, gives his favorite stocks for 2022. I think he used to be with maybe CS First Boston. He is a really the most highly regarded analyst when it comes to bank stocks, Mike Mayo. Okay. And his 3 favorites. So let's see what he has to say. Financial stocks are off to a strong start. Wells Fargo Research believes the sector has room to run this year. S&P and regional banking exchange-traded funds are both up more than 5%. S&P Bank and regional banking ETFs. We're going to look at 2 of them in a moment. Guys, stick with me. We're going to get into the action here, okay? Financials should benefit from changes in interest rates, good credit, efficiencies from the tech revolution, attractive valuations, and COVID recovery, says top bank analyst Mike Mayo. I'm going to give it to you. Let me see what he likes, okay? Banks have record dry powder, meaning cash reserves, which should lead to the fastest growth in a generation for traditional banking revenue. They've got technology innovation. Okay, so Wells Fargo's top bank picks: Bank of America, like the Goldman analyst said, Signature Bank, Amex, Chubb, and Apollo. So and Bank of America is Mayo's top pick among large cap banks. Okay. His target is 60. The stock is like in the mid 40s. Let's just see where. Okay, the stock is 48. He sees it in the 60s. You never know. Maybe it could go higher. If you're a client of mine over the long term, then you are already in Bank of America and you've had it for a long time, and that is awesome. And I'm really happy about. Okay, and Josh is really funny. Josh says, "Give me ham on 5 and hold the mayo." That is good. Hold the mayo. I'm sure Mike Mayo never heard that one before, but Josh, you and I, baby, when it comes to dad jokes, I think you are the king, and I love dad jokes. So thank you very much. Good dad joke. Why not buy the bank ETF? This is a good segue, Jay, to say bank ETF. So let's take a look at two. First one I want to look at, and I'm going to make this a little bigger so you could see it. Okay, let me make it even a little bigger. All right. The regional bank ETF that I'm looking at right now is IAT. This is the iShares U.S. Regional Banks. Okay, she says U.S. Regional Banks. It's from iShares. Okay, and I look at this because it's pretty much the biggest one. So it's just the go-to one. It's been around a long time. I've been following this ETF as long as I could remember, probably since it's been out. It's probably been out over 20 years, which just goes to show you how long I have been following this. Oh, it's not the biggest one, according to this. KRE is the biggest one. That's the KB regional, whatever. It doesn't really matter. IAT is the one from iShares. Okay, but what I want to take a look at is what's in it, and that is. I'm sorry if I'm giving you a headache when I'm scrolling. I'll take this off for a second. This is not really. You know what happened? I think I made the screen so big that it won't fit everything into it. It's got an efficiency rating. Okay, we'll take a look at this now. All right, but we're not going to take a look at that now. So IAT is. Let's do a share screen. Share screen. All right, how's that? That's better. Okay, let's see if I can make this a little bit bigger now. There's always a way around the technology if you know how to use it. Okay, but it tracks its benchmark very, very well. And I want to just take a look at it over here. It hit a 52-week high today. Okay, and it's in. Don't worry about the chart. That's really not what we need to look at. Okay, its expense ratio 0.41. It's definitely not on the lowest side of exchange traded funds, but it's not on the highest side either. It's got a small dividend of 1.73%. I say small, it depends on what you think is a small or large dividend to get into. But it's up almost 9% already this year. And we're only into the year for 4 trading days. It's only Thursday. So it's already doing well, but it had a pretty good year last year. Okay. And in the last year, it's up 38% in the last 12 months. That I think is a really good way to get into the more regional banks. And let's take a look at what kind of banks are in it. Okay. The profile. I'm sorry about that. I think what happens is when you make the screen too big, but I want to show you the stocks that are in this. Okay. Let's get to the profile page. There we go. Now I'm going to make it bigger so you could really see it. Yeah. Okay. I don't want to look at the sponsored content crap. Yeah, it's just not made to be this big, so I'll have to just walk you through it. Okay. But the stocks that are in this bank, in this ETF, PNC Financial, Truist Financial, U.S. Bancorp, First Republic, SVB, Sovereign, right? Fifth Third, Huntington Bankshares, Regions, Key Corp, and Citizens. And the top 10 banks make up over 50% of the fund, so they're a very important part of this fund. But if you want to get into a bank ETF, um, which is outside of your traditional only, if only, if you just want to get outside of just having JP Morgan and Goldman Sachs and Bank of America, because you might feel that you've got enough of those and you want some more diversification in some other areas. Okay. This is probably one of the ones to take a look at, not necessarily just this one, but a regional ETF, regional bank ETF. And I am trying to show you some stuff here. So let's go to the next one, XLF. Now, XLF is the big one. This is, let me stop the share screen for a second. Okay, I hope I didn't just totally screw up the show. All right, I'm trying to figure out how to get rid of the. Okay, that's better. Sorry about that, guys. Yeah, it's just one of those days I'm having a little trouble working the controls. I usually don't have this, but the top 10 in the XLF are the ones you've heard of. Okay, it's Berkshire Hathaway, JP Morgan, Bank of America, Wells Fargo, Morgan Stanley, Goldman, Charles Schwab, BlackRock, the big fund manager, Citigroup, and there's a little S&P Global top 10, 53, just about 54%. So this is the one. If you want an ETF with bank stocks, and it's got a pretty low expense ratio, and I'll see if I could find that for you real quick. It's got 68 holdings in it. It's got it's already up this year. I saw the expense ratio. It's 0.12%. Okay, I don't know if you could see that, but it's 0.12%. And if we look at how it's doing year to date, it's already up over 4% year to date with a 1.5% dividend yield. So that's it. These are the two. XLF and IAT are two of the exchange traded funds that I wanted to show you. IAT is regional bank shares, and it's just going to drop in there, mid-size and smaller banks. If you want to own something aside from your typical JP Morgan's, Bank of America's, Wells Fargo's, Goldman Sachs of the world, the XLF has banks as well as some insurance companies and other financial services companies. And that's another way to go. The XLF is very large cap. I follow this one every single day. It's got a low expense ratio, and this is the way to capitalize on, the overall sector. Okay. Which one do I feel is better? I'll say this: the XLF, it's bigger companies, bigger banks, more lines of business like investment banking, and they do all the mortgages and everything else that you'd expect a big financial services company to use, because they have the more diversified lines of business. They're bigger companies, incredible access to capital markets. I would say that one would be more stable, because it's basically a portfolio of blue chip financial services companies. But IAT, or regional banks, there's nothing wrong with that either, because the banking sector in the United States happens to be in phenomenal shape. After the 2008-2009 bank crisis, the credit crisis, and then going through COVID, banks have done so much to become such strong entities, and regulations have been more strict. So these banks have more capital on hand that they have to hold on to. There's never been a better time for bank stocks in terms of their growth and their business profile in terms of stability. There's never been a better time. So that's another reason why people like to own banks. And you get a lot of dividends in this space. A lot of banks pay dividends, and only recently have banks been allowed to actually raise their dividends because they were curtailed. They weren't allowed to raise dividends while we're going through the heart of the pandemic. So last thing I'm going to say is this that you should know. I just feel like I'm just a rambly show. Last thing I want to say: the key reason to own banks is because as long-term interest rates start to rise and short-term interest rates go up maybe a little bit less, when the difference between short-term and long-term interest rates gets a little bit bigger, banks make more money. And bank reserves are so huge. The amount of cash that consumers and businesses have in banks are so huge. Your deposit at the bank is your asset, but if the bank has to pay interest on it, it's their liability. So banks could keep paying you low interest while they get to reinvest that money in investments that pay a higher return. And as interest rates rise, banks could earn a higher return on your deposits while still paying you very low interest. That means the banks could start to become just tremendously profitable entities. And when that happens, not only do their earnings per share go up, but then investors become enthusiastic about banks and their growth prospects, and the PE ratios of banks go up. And that's when you really get the expansion in price. We saw a lot of that last year. So you're not early to the party. But as far as bullish calls go, top analysts feel that as the economy continues to strengthen in the United States and globally, and interest rates rise, and corporate defaults are still very, very low, this is a really good environment historically for bank stocks. And the ways to go about it, as Jay asked, are ETFs if you're looking for a diversified approach. There are plenty of financial services exchange traded funds. I just went over the two that I am most familiar with. I'm familiar with other ones as well, but I find the other ones are so similar. How many regional bank ETFs and how many large cap financial services ETFs do I really need? These are very liquid, they're very large, and they get good ratings from all the companies that rate them. They stick to their knitting. They don't style drift. So those are the two that I'm looking at, and that's why. I want to thank you for your time. I will be back Monday unless something totally calamitous happens in the stock market tomorrow. I typically don't do the live stream on Fridays, and I'm hoping to get back to my weekly email blast. It's just been so busy, and but I miss that. I feel like the weekly email blast was like the beginning and basis of my content creation. So I definitely want to get back to that. All right, see you Monday. Thanks so much for watching. Bye.